Hello, everyone, and welcome back to the PetroNerds podcast. This is episode 105 of the PetroNerds podcast. It is April 5th, 2024. It is Friday. I am delighted to be here with you today. I am Trisha Curtis, the CEO of PetroNerds and the host of the PetroNerds podcast. And boy, do we have a lot of ground to cover. If you've been watching the market or you've just seen oil prices, you're seeing oil prices at 87 and change right now. For WTI, you're seeing Brent at almost $92 a barrel. And there are a lot of different reasons for that. So I'm going to get into that. I'm going to timestamp the podcast with everything that I do with oil prices and the 10-year yield, and then we're going to talk about the main things right now for this introduction, which are really oil prices and geopolitics and everything moving oil prices. And then we're also going to talk about inflation and the Fed, because there was a lot of Fed talk this week. We had jobs data today, and there's a lot going on there. And the reason, so this podcast is going to be the main body of this podcast is the CFA Investor Summit presentation that I gave in Dallas. Now, I did this in November, but bear with me. There's a reason why I chose to drop it this week. I wasn't actually going to do it. I thought it had been dated. And then I was so frustrated with a lot of the Fed stuff this week and just frustrated that thinking that the Fed might be getting this wrong. And it reminded me of this very kind of lippy presentation that I gave. And I'm going to put some context around this after I do this intro, but I just want to note this is the CFA Investor Summit. It's a talk I gave November 10th in 2023, and Robert Kaplan, a former Fed guy, was actually the keynote speaker. I'm pretty sure he was paid. I was not, and I was the only person speaking on energy. So this is an investor summit for investors, and it's the people that you see on CNBC on a regular basis. And it was very interesting because these folks were saying a lot of things. I thought the presentations were great. I didn't really like Robert Kaplan's presentation. I didn't think it didn't sound anything like the Robert Kaplan I knew from the Fed. And so I was very surprised when he had a very simplistic view of China and the energy transition and EVs, and he was leaning into that actually. And I didn't think that was correct. And then I really didn't like how he was talking about inflation and how it didn't impact anyone that was making less than, if you made under $51,000 or something like that, it was impacting you. But if you made above that, it wasn't. And I thought that was ludicrous. So I was not happy about that. So I'm kind of you can tell I'm ready to sort of just let it rip in this talk. So I got a lot of laughs. I had people that actually wanted to take selfies with me afterward. And then and I just said it like it was. So if you're looking for talk on China, this presentation, I cover everything from, oil prices and geopolitics, which at the time was not, this is right after a month into the war in Israel. So we talk about that. That's why I always also wanted to drop this, because I spent some time talking about what happened within Israel and the response by Iran, which is very relevant right now. And then really talking about the points I disagree with Robert Kaplan. I talk about the energy transition, why it is not ESG friendly. So we spent a lot of time on that, a lot of time on China, and as well as talking about the fishing vessels ramming in the Philippines, which is also going on right now. So all this is held up actually well over time, except for, oil prices have really ramped up. And then the White House, which there's some funny commentary there, and the blank piece of paper and solar, which I've mentioned before, but hilarious in White House policy. They're very anti-U.S. Domestic oil and gas production policy. And then Chinese oil demand, and I close with the UAW auto strikes, which I think is also very timely in terms of thinking about the competitiveness of electric vehicles and the fact that Janet Yellen is over in China right now talking about overcapacity. So with that, that's the talk. I think you're going to absolutely love it. I do swear in it once, so I apologize, but I was ready to sort of let it rip, given how I was very frustrated with Robert Kaplan's speech. So that being said, that's why I dropped this, because I'm talking about the Fed. Two big things right now. It's oil prices and it is the Fed. So we right now we're looking at 87.37 for WTI. We're headlong into this weekend looking at nearly $88 a barrel, or potentially $88 a barrel. And we'll see on Sunday what happens if it goes up or down. Brent is 91.65, and we're looking at Henry Hub at a $1.97 or $1.79. So Henry Hub is still just extremely low. And then we have Dutch TTF, natural gas prices in Europe are well under $9. You're looking at $8 and change. And the 10-year yield, very, very important, which we'll get into, is 4.37. It could have actually gone higher in the time that I've been prepping for recording, but 4.37 for the 10-year yield, that's huge. We've had so much repricing in that rate curve. And I do want to point out, as I talk to clients, and I do in presentations. So another reason to be Petronerds client, but and I've talked about on podcasts, but the correlation between the 10-year yield and the rate repricing and the volatility in oil prices is pretty tight. I mean, when you're seeing yield prices move and you're seeing questions on the Fed, you're seeing oil prices move as well with it. And there's a lot going on with that that's a little more involved this past week. You're just seeing very, very clear in the data that we haven't in weeks past. And that's because of geopolitics, that stuff getting priced in. And that's also a big, big question and pushback on the Fed. So when you're seeing the 10-year yield at 4.37 and you are, just weeks past hearing the Fed say, yeah, everybody's pricing in multiple rate cuts, yet that doesn't make sense, right? So the yield curve is telling you that the market is pricing in that the Fed is not going to be able to cut rates because inflation is still too high and you have a lot of other factors. And part of the reason inflation is too high is because of, very Fed thingies and very US centric, but also because of geopolitics and oil prices, which we will get into. Gold is also telling you that same story. We're seeing gold at a whopping $2,346. That is huge. So at the end of last year, you sort of know gold prices 1900 2000, and then we've seen this really nice ramp up in the last couple months, and that's on the basis that yes, you're hearing central banks are buying gold. We hear China buying gold, we hear of different central banks buying gold, but we also know that gold is the hedge, right? So is oil, is a hedge against inflation. So oil's a hedge against inflation. People want hard physical assets when they're thinking inflation, and so it's very interesting to think about a dovish Fed or still continuing talk of these Fed rate cuts, and yet the market doing what it's doing. And so we need to break that down. So there's multiple factors that they're interwoven and they're a bit messy, and I want to get into them. Today we had the jobs report. So this is Friday. We had the jobs report. It was much higher than expected. It was 100,000 jobs higher than expected. So it was expected at 200,000. It came in at 300,000. That actually moved unemployment back down to 3.8%. Wages are up 4.1%. Now, everybody keeps saying that's in line with expectations. That means wages are still up 4.1%. That's massive. That means that if you're hiring somebody, you're having to pay more. Now, very interesting in this is now Bloomberg earlier this week had a big thing. If you saw on their website, it was on immigration, and it was showing all the stuff on immigration, which has now become a bipartisan issue. I have to talk about immigration, and I'm not trying to politicize this. I'm trying. It's really serious, and I'm not happy about it because the way it impacts inflation. But the Fed is talking about it, and it's been talked about a lot now, and you're starting to hear it talk about in the stock market quite a bit. So 10,000, Bloomberg has an article, 10,000 people a day coming across the border. That's a pretty big number. So the impacts to inflation are pretty significant. And so you saw in the jobs data, they were talking about that and saying, well, okay, so that's partly, you have folks coming in, so that's beneficial. Interesting to me that the wages are still up if you have all these available migrants coming in that are able to take jobs, you would think that that would help on the wage side, but it's not. So where you see the jobs growth, you see it in leisure and hospitality, you see it in local government, and you see it in construction and places. So all that actually supports sort of the leisure and hospitality, and sort of actually supports the fact that you have all these migrants coming in. The interesting thing is that Powell spoke twice this week. So you had lots of commentary from different Fed officials. Neil Kashkari spoke yesterday. Now, he's not a voting member of the Federal Open Market Committee of the FOMC, so he's not voting on whether we're raising rates or lowering rates. However, yesterday he came out and said, and this is what's so messy with the Fed right now, is that all these speakers coming out saying various things and everybody trying to parse it. But he came out yesterday and he said that we may not be able to lower rates because of the sticky inflation. That was one speaker out of many saying lots of various different things. Another speaker said, oh, we think we can still cut rates. And another speaker said, maybe we can't. And then Jerome Powell spoke twice this past week. So he spoke earlier in the week at an event, which was very, very interesting. But he said basically the same stuff except for the immigration, which he was at Stanford. I think it was Wednesday, and I listened to that. And he mentioned immigration multiple times. And he tried to do it in a non-political way, but basically that you can't ignore the data. The fact that it's such a big deal and he's mentioning it now and hasn't in the past is very, very interesting. And I say it's very interesting because the Fed doesn't like to comment on fiscal spending, and fiscal spending is a huge contributor to inflation, and is a huge contributor to that they're fighting. So, and we have massive fiscal spending. So a lot of the reason why the stock market is high, a lot of the reason the jobs, everything, and inflation is fiscal spending. But with immigration, Jerome Powell mentions it multiple times. And this folds into the jobs piece because it was mentioned a lot when the jobs data came out. Listeners know I'm a big fan of Diane Swank. She is the chief economist with KPMG. And she gave some commentary, was talking about it this morning as well, on CNBC on the immigration data or on the numbers. And so what we're seeing is that we saw it was Michelle Bowman also said today, she said migrants are pressuring housing. So if you're having 10,000 people come in a day, and Jerome Powell, when he mentions immigration multiple times in his speech at Stanford, he's asked about it, but he talks about it, and he essentially says, hey, the numbers are higher than we thought. And he said, even if you go to the border, then you find out they're higher. So he's saying, hey, he's sort of saying it's a positive thing. It's helped. It's part of the story of why we've seen unemployment the unemployment rate so low, and the fact that we've been able to raise rates, but everything's sort of working out. He's saying part of this is because of the immigrants coming in, and the fact that they're supporting on the job side. Now that's tricky because there you had Stephen Leisman talking today on CNBC and asking questions. And I've heard Bloomberg folks ask the same thing about exactly how many migrants are legal, how many are illegal. And so who is actually contributing, who's actually paying payroll taxes, and who's not. So if it's under the table and you're paying its construction and somebody's being paid cash, yes, that's still contributing to the economy, right? If you're spending money if you're buying something in Colorado, you're paying sales tax, right? But you're not necessarily contributing to payroll taxes and federal income taxes. So that seems to be a little confusing, and you were hearing that with a lot of commentary today. But the fact that we had 300,000 jobs added versus 200,000, now people are talking about this. So Michelle Bowman, a member of the Federal Open Market Committee, also said today that she mentions migrants and contributing to housing inflation, the fact that if you have more people coming in your country needing housing, that's going to push up the demand for housing, which is going to push up the pricing. So that was that commentary. So they're trying to do this in a way that isn't getting political, but the fact that Bloomberg is talking about it, the fact that it's out there, it's just this massive, huge data point. So you're talking about millions of folks coming into the country, and that's going to have an impact on local services, on everything. So there's I think we're starting to see that in the data, and I think that's why the Fed actually has to start talking about this, because it's very real. So interesting enough, she also said that. She also says that an additional rate hike might be needed if we continue to see this level of inflation. And it's really messy, because if you listen to Jerome Powell speaking this week, he doesn't, I listened to him twice, and I think his tone is always dovish. The way he says things comes out dovish. However, what he says isn't particularly dovish. He says we're going to have to analyze the data, but it always seems to come out dovish of like, hey, this is where we're going. He didn't reiterate over and over, hey, we're ready to cut rates. He didn't say that. And so it was very confusing, the fact that he's saying what he's saying, which was honestly kind of messy and muddled, versus all the other Fed commentary that we were hearing. And the fact that you have yields, the 10-year yield pushing up, is telling you that the market's sort of repricing everything. And you're seeing this, if you're seeing the stock market climb to the highs it did today, if you're seeing all the stuff in the data, if you're seeing this persistent and sticky inflation, you're seeing oil prices up to where they are, and oil prices have a lot to do with this. The fact that you're seeing oil prices up, and this is weighing on people, this is weighing people's minds, the fact that you can't move ships within the Red Sea, that's contributing to inflation, that's contributing to tanker rates going up, contributing to shipping rates going up, which means good prices are going to go up, and goods prices were coming down. That was one of the biggest benefactors for inflation and moving inflation down. And if you have all these job gains, and you have pressures on wages and everything still going up, you're not meaningfully bringing inflation down. And that's really serious, because if you go to the grocery store, you feel that. And there's lots of data out here right now suggesting that, grocery prices are up by almost 40% from pre-COVID levels. So that's huge. And so what's really, really serious about this, and why the Fed is having trouble with this, and why you hear commentary on the politics side of why the Biden administration is frustrated. They say, oh, we're getting inflation down. And you even hear CEOs say this. They'll say, oh, we're going to be fine. Our business is going to be fine. You heard the UPS CEO say this as well, and say inflation's coming down. Well, that's not what we're actually seeing when we buy something or we go to the grocery store. We do not see inflation coming down. And there's a difference between inflation, like the rate of price increases coming down, and that is coming down. The rate of the increases is coming down, but prices are not coming down. And so the problem is that unless you are making a crap ton more money, unless you're making 40% more, you really, really feel it at the grocery store. And so that's a real problem, in that we have not, our society, we have not experienced inflation like this, and it's really bad for the economy. It destroys your income wealth. It destroys your wealth. It destroys your ability to save. It destroys your ability to do things, to go on vacations, to do the things that you want to. So it makes a situation where people have to work harder for a lot less, and that's really, really difficult. And it gets into energy, because we're not seeing the benefits now. We know energy in terms of an inflationary standpoint, and I think it's really important to point out that, Americans and a lot of folks are used to the inflationary and disinflationary impacts of oil, right? Oil prices go up, you see it at the pump. But when oil prices go down, you also see it at the pump. So you get to feel that immediate benefit of the consumer feels that. Now we feel it in the oil industry. If you work in the oil industry, that you lose jobs and it's very painful. Natural gas is not working that way. And I've spoken about this on previous podcasts, but I think it's really, really serious to think about. It is the natural gas prices are a buck 79, but that is not what the consumer is paying. And natural gas is over 40% of the US grid is natural gas. And so if you're using natural gas, whether it's for power generation or using natural gas directly into your home and it's powering your appliances, you should be seeing lower utility prices, not higher. And that's not what we're seeing, because all the utility companies have raised rates because they're shoving renewables into the grid, partly because they're just making money, but also because they're shoving these very expensive renewables into the grid and trying to decommission these coal-fired power plants and all these things, and it's not working. And they also, like in Colorado, we have a cap of no more than 20% of natural gas in the grid, which is just absolutely ridiculous by Excel. It's extremely frustrating that in any given day, we're probably, using 40% coal, but we have a cap on natural gas. And we're shoving these renewables in and we're increasing the price of electricity. This is meaningfully contributing to people's pocketbooks and inflation. And it's not something the Fed is talking about, but it's very, very serious. So I'm going to pause on that for a second and I'm going to go back to oil and geopolitics, which is this podcast is going to walk you through a lot of that from what was happening with Israel and Iran. Now, the reason you're seeing oil prices go up to the level that they are now, they're finally starting to really price in geopolitical risk. So all the geopolitical risk in the past several months that I've said that is not being priced into oil, starting to really be priced into oil. Now, everything's coming together. We had production down a little in the US. So we were down in the past month under 13 million barrels a day, partly because of winter and other things, but also rig count and everything. So production down a little bit in the US. You have Russia, and I talked about this in some LinkedIn posts previously, but Russia has said that they are going to lower their exports. Now, I don't necessarily believe they're actually lowering their exports. We have to actually see the proof in the pudding, because they have yet to actually do that since this war in Ukraine has started. They've actually increased exports, but on the refining side. So if their refined product exports decline, that is going to impact oil prices. And Ukraine has been targeting Russian refineries, and so they can impact their output. And it was interesting because apparently the Biden administration went and asked Ukraine to not target Russian refineries, and Ukraine basically said, "No thanks, Joe Biden," because Biden cares a lot about this oil prices and reelection. So that's definitely one piece. And then obviously you had a terrorist attack in Russia. Russia's response, and very sad. Now the Islamic State claimed. They claimed that terrorist attack, but Russia was talking about going after Ukraine. So lots of stuff going on there. You have this ongoing hot war in Ukraine, which is very messy, and it's continuing. Right, there's no end in sight to this. So you have this ongoing war. So you have that backdrop, and the fact that Russia, if they are going to decrease their refinery output, that could actually be the first time they're lowering output in some case. OPEC has come out and said that they are reiterating their cuts. They're going to maintain their cuts in place at least through June. So that helps support the market as well. But really, the big supporting factor for oil prices is the tensions and the volatility and everything going on with Israel, Gaza, and Iran. And the fact that this Iran piece is that, nobody wants to talk about it as Iran, that this is just proxies and this isn't a direct thing with Iran. Now, I've said it from the very beginning, since we had this war in, these atrocities in Israel on October 7th, the oil prices were not appropriately pricing in the geopolitical risk premium, because this war wasn't going to go away. This was the atrocities, and I talk about this in this podcast, so you can hear that the atrocities were so terrible that they were trying to invoke a big response. They got that response from Israel. They wanted the world to be mad at Israel. The world is now mad at Israel. But now you have lots of proxies, right? You have the Houthis attacking ships within the Red Sea. You actually have had deaths in the Red Sea now. So you have these Houthis, which are a Iranian-backed proxy, right? Iran funds them. So it is Iran. Iran is getting this money, about nearly, now probably more than $5 billion a month from if they're selling 2 million barrels a day of crude oil to China. So Iran's getting this money largely from oil sales to China, and then they're funding all these groups, whether it's the Houthis in Yemen that are attacking in the Red Sea, whether it's Hezbollah north of Israel, or whether it's Hamas directly. All of these are Iranian-backed entities. And so the risk is now that, everybody thought, okay, well, this will be contained through proxies. And so the immediate thought with the stock market was that this isn't going to be a wider war and it's going to be relatively contained. Israel has attacked a base in Syria, and it killed an Iranian leader. Now, Iran has obviously taken this very seriously, and they say they're going to retaliate. And that's something that the U.S. does not want. Now, everybody, if you listen to analysts, you listen to BBC, and you hear this talk, people say, "Well, Iran does not want a wider conflict." I Wanting a wider conflict and what Iran does are usually two different things. Their hardliners typically get involved. I mean, the Biden administration has been wanting to lift sanctions and have appeasement and lift crude oil exports out of Iran since they came into office, day one. And Iran has known this. And so every time they get really close to this, Iran does something, and the hardliners do something, like what they did with the young women and the headscarves, and the brutalization of these women, killing of women, and everything. Very sad to me that the world has not responded in kind with the atrocities that Iran commits to its own people, and everything, and what's happening there. But that being said, is that Iran produces a lot of crude oil. They produce over 3 million barrels a day crude oil, probably to about 2 million barrels a day that gets exported to China. The rest of the exports probably go to North Korea. That is all under sanctions. That shouldn't be moving. Now, we have the choice to enforce that. And so the fear and what's being priced into oil right now, or the risk, is that we actually have to do something about it. Is that the stuff with Israel and Iran goes head to head, that Iran starts attacking us. And we've already seen so the fact that Israel attacked a base in Syria, we've had loss of life on our bases in the Middle East because Iran has attacked them, entities, Iran, whatever. The point is, American bases have been attacked, so that's been going on, and that has been really pretty downplayed. But as this stuff escalates, bringing in the U.S. to the fold, whether the Biden administration wants to or not, they're going to be brought into it. And so there's no good political answer for the Biden administration. I mean, they're trying to walk back the support to Israel. We support Israel. That's just a reality. So you're not going to be able to walk that back. Now, there was and this is getting very controversial now with the Biden administration because of the pro-Palestinian groups, but there was a devastating a loss of life from a humanitarian aid workers that were hit. And if you listen to BBC today, you'll hear the conversations about this, that there was a lack of communication, or that Israel knew about these aid workers there, but that didn't get fully communicated. And so one of their vehicles got a hit and people died. And so there's been a reaction to that. But that's sort of like on the sidelines of that. You have this pressure within the administration, but that's not really what's going on with oil prices. Oil prices are really about the fact that this is escalating and it's getting wider, and the fact that Israel's saying, nope, we're not stopping. And I think if you're really trying to dive into this, and you're listening to you're listening to Israeli podcasts, and you're listening to this, you'll hear that, yes, the folks in Israel maybe don't support Benjamin Netanyahu, the leadership, but they support the war, and they still don't have they're still trying to get their hostages back. So this is something where they support the war, they support getting rid of Hamas, and so this is not a conflict you're going to see go away anytime soon. And so the risk that this escalates and this becomes wider are pretty serious. And that's partly what you're seeing in oil prices. The other thing you're seeing in oil prices is all the stuff we talked about with inflation, right? Is the commentary in the Fed, the fact that the Fed is being about as clear as mud, and that is really similar to the Biden administration on foreign policy being about as clear as mud. When you keep changing your positioning and you're not direct and you're not clear, it's very hard for people to understand that. And right now, what's happening is that with the Fed uncertainty on the rate trajectory, if the Fed would just come out and say, hey, if Jerome Powell would come out and say, hey, we may need to raise rates again because I am not comfortable with where inflation is, and I told you that I'm going to get it down to 2%, the market would do its job for it, right? Everything would reprice, and you would see yields go up for mortgages, and you would really start seeing housing prices come down. But he won't say that. He won't do that. So he's trying to keep everything really nice and cozy, and the market is doing it for him by repricing in gold, repricing in oil, and oil's this nice hard asset, right? So part of this is that people are throwing in, and they're realizing, hey, I've been out of oil for 2 years. Maybe this ESG thing doesn't make sense, and people are back into oil. So there's multiple components going on that is not simply just geopolitics. We have talked extensively about the Fed and what immigration numbers are doing and things like that. I just want to add, lastly, is that Janet Yellen is over in she's over in China right now. And again, this is the flippancy with the Biden administration in terms of just being clear on foreign policy. I would say this other administrations as well. Janet Yellen was over there a few months ago, literally kowtowing and bowing down and kissing the ground. And now she's over there saying, hey, the surveys say, not me, but the surveys of our companies say that you have overcapacity and they don't feel great in China. Well, no crap. And this has been the case for 40 years. Nobody really makes money in China. So it's very, it's frustrating to me when I hear Goldman Sachs come out and they actually lowered their high yield interest. That's not fair. People who are in a high yield interest account for Goldman Sachs should call up Goldman Sachs and say, please look at the 10-year yield curve and you move that rate back. That's just Goldman Sachs trying to save money. Also, you can't, Goldman Sachs, when they say they're not concerned about China, they have wealth entities in China. No one's going to pull completely out of China when they have these investment arms and these wealth entities. And they can't tell you the truth about what they actually feel and think on China. That's just the reality. So when Janet Yellen is talking about overcapacity, this is really real. We're seeing this across the board. This is why this podcast is really timely, and I think you'll appreciate it. But when you are looking at electric vehicles right now, Ford stock was up. They really cut the price for the Mach-E, for the Mustang electric vehicle. That helped a lot with sales. So if you cut the prices, things are going to sell. Now, China is absolutely dumping EVs on a huge extent. We're talking electric vehicles at the cost of $10,000 they're dumping into Europe. So that's really damaging. And it's not just damaging from an electric vehicle standpoint and these motor companies, these vehicle companies. It's damaging from the internal combustion engine, their ability to build internal combustion engine vehicles. That's what's damaging, right? They're undercutting, they're kneecapping these entities that are kneecapping manufacturing. So there is a reality, and people, I was listening to a bunch of electric vehicle podcasts, electric vehicle China podcasts, and, they keep saying that this is not what China's doing. It is what they're doing. They actually pulled out 3 companies that were dead, and there's some articles that you can find in Wall Street Journal, Bloomberg, and they brought them back to life. Now, what is the point of bringing back 3 dead manufacturers that in the first place? That's only because, one, you're not selling things at home, so you're trying to keep this base together. So it's something that basically China's doubling down on what they know, which is manufacturing and exports. But there's also the added benefit of kneecapping foreign competitors and putting them out of business. They've done this with solar. They stole the technology from Germany, and then they manufactured this. They dropped the cost with forced labor, and they dropped the cost with cheap coal, and then they export it and they flood the market. Then everybody buys it and no one else can compete. That's kind of the MO. That's what they do. And so you're definitely seeing that. And if you think it's just about electric vehicles, it's not. It's also about internal combustion engine vehicles, and it's about those those major auto manufacturers that only in 2008 were bankrupt. So you just have to think about this and put it in this context. There's a lot more at play than meets the eye. But with that, thank you guys so much for listening. I think you're going to absolutely love this podcast. I also want to just say, look, if you are on the fence about becoming a client of PetroNerds, I am pretty sure that the podcast should tell you otherwise. But come in, talk to me. Let's talk about you coming on the podcast. Let's talk about you sponsoring the podcast. Let's dip your toes into the water. And then let me show you what PetroNerds can actually do for clients. But thank you guys so much. I really appreciate listening. And lastly, I will add, I am still running PetroNerds. That is what I'm doing on a day-to-day basis, but I've joined 2 different entities and organizations. I am an energy fellow at the Common Sense Institute, which you heard on the podcast last week with Chris Brown. So expect great things on that, on the energy front in Colorado. And I'm also a senior fellow with the very new and awesome National Center for Energy Analytics. This is Mark Mills's new organization and think tank. Super pumped about that. You're going to see a lot of awesome work coming out. So with that, look forward to talking to you guys soon. Bye. Awesome. Well, it is a pleasure to be with you guys today. If you are sleepy after lunch, I can guarantee you are not going to be tired after this presentation. Because if you think I have a lot of slides, I won't even tell you how many I deleted, but it's plenty, probably as long as the deck. So we have a lot of ground to cover today. I did disagree with quite a bit of what Robert Kaplan actually said. Not his whole entirety, but sort of a simplistic view of China and a simplistic, really, really simplistic view of the energy transition, which we'll be talking about today. And I think I'm going to make it very clear that the energy transition is not ESG friendly. And that's actually pretty important for you guys on the investment side. So right now I'm calling this navigating a game of 3-dimensional geopolitical chess. I mean, it's really difficult to even talk about where oil prices are at today and where they should be, where are they going, what's going on with the state of geopolitics, what's going on within Israel, what's going on within Ukraine, the tensions we have in the South China Sea. I think not the last speaker over lunch, but the previous speaker talked about Taiwan. Most people aren't talking about that. My podcast, if you haven't listened to it, please do. This is the PetroNerds podcast. I talk about all this stuff and a lot more. Obviously, it's not quite as deep as I get into with clients, but it's still pretty good. So major takeaways I'm going to cover.
sort of the global economy, what's going on. I mean, the big themes I want to cover is what's going on in the state of geopolitics, the complexity of what's going on, why the geopolitics of war matters so much, and how oil prices are really not baking that in right now. And then I want to talk about the energy. We are going to talk about the energy transition, how it folds into the economy, why it's not ESG friendly, and the role that China really plays in it, which is why it's probably not going to happen the way people think. And I'm obviously very long and very bullish on oil and gas. And if we have time and we get to it, normally spend a lot of time talking with folks about the state of the economy, which I don't have to do because you guys had previous speakers and you know it well. But we'll talk about that to a degree, and I'll fold it in, and we'll talk about U.S. shale and the fact that the U.S. is producing 13 million barrels a day, which is a bit of a factor of why oil prices are where they're at, because we have a lot of production on the market. So, you know, some of these realities, and unfortunately I don't have a thing where I can see this, but you know, oil prices are telling us something, right? Oil prices are at 75 and change, 76 today, so they're telling us something. Part of that is that I think a lot of folks trading oil aren't geopolitical experts, and they do not appreciate that the war in Ukraine is still going on, and that's one thing that's sort of held there, but it's ongoing, there's no end in sight, it's very expensive, and there's no solution to it. And then you have another piece, which is the war in Israel, or the war in Gaza. And the spillover effect, I mean, the potential for spillover is huge. There's also no end in sight to that. And if you think about the run up to the war in Israel, the rapprochement that we almost had with Saudi Arabia just days before, and really just the trajectory of oil prices. We were at $94 WTI in September 27th, and we're at $75 now. So we're in a pretty volatile state for oil prices. We can talk about mergers and acquisitions and what's going on in that space. Obviously, Exxon bought Pioneer. That's a really big deal. Chevron bought Hess. Now, are we going to see a massive wave? I don't think you're going to see a massive wave if oil prices kind of keep trending down. Nobody wants to do deals at $70 oil. I mean, it might be a great place to actually get some deals done, but it may not happen, and we may not have that wave. And also you have to put in context why these acquisitions happened. I mean, the lack of love for oil and gas is huge, and essentially these companies have a lot of cash, and the only thing that investors are allowing them to do is to buy stock. So these are all stock acquisitions. And I think we really have to be paying attention to nat gas prices. I mean, if oil is soft this year or in 2024 and nat gas is up a bit, I mean, $3.50 nat gas, a lot of gas plays start looking very, very appealing. Gas is a much smaller molecule. It's extremely easy to produce, and we can get it out of the ground. And the state of the natural gas environment of what happened to U.S. shale in 2022 when we averaged $6.50 in MCF for nat gas, that was game changing for this industry, because every private producer went to town and started, de-risking acreage. And so this is when operators really start stepping out of the so-called core positions, and they start going after gas. And with gas comes oil. It's a driver for oil. You get NGLs, you get condensates, and it's game changing for the business. So that's the space to watch. And then I think, Europe, that's great for gas in the US if gas prices go up a little bit. But we are seeing gas prices go up in Europe already, and we're seeing that because of a potential sabotage to the Finnish-Estonia connection line that was sabotaged. And we're also seeing from the gas that's been turned off out of Israel, part of that's driving prices up in Europe. And Europe was saved by the past winter because they really didn't have one. If we have a winter this year in Europe, it's probably not going to feel great. And Europe is already feeling the pain of a couple years of higher energy prices, a couple years of higher oil prices. Europe is not in a great place, as I think you heard previous speakers talk about. Germany is extremely exposed to China, both on the import side and export side. And they're headlong into a recession. And Germany and Europe actually do, despite what they say, they do actually consume quite a bit of oil. And if that starts softening, which it's probably already doing, that's probably another reason why we're seeing oil prices a little weaken. And we're all definitely seeing the weakness in China. So that would be hurtful for them. And then I think really you just have to think about what are the risk factors. If you're thinking about oil and gas and shale and what are we thinking about for the next couple of years and what does it look like, you have to be thinking about, is 2024, what are the risks for 2024? For oilfield service providers, that's probably that the E&Ps aren't smart enough and don't understand the market, and they're not seeing that where oil prices are going, and they get nervous. and they aren't steady with their activity levels. They really should be steady with their activity levels because we've been through so much volatility, and it never makes sense to pull back and then ramp up. But we'll see if that actually happens. So there's a risk there, and you're already hearing service providers get pressure from E&Ps saying lower your prices, and you're already hearing the service providers tell the E&Ps, hey, we can't lower our prices because our labor costs are still too high. So this is just a reality, and this is going to continue to play out. So we have had a perfect storm for oil and gas, right? We've had the lack of love for oil and gas is real. You know, we had COVID, but before COVID, we had years of negative returns for shale. And then you have this rise of this massive anti-oil and gas movement. COVID definitely helped propel that. People thought, oh my gosh, we can drop 8 million barrels a day demand overnight by shutting everybody in their homes, and this is what the world could look like. So everybody kind of leaned into that. And then you have this just crazy, massive ESG movement and energy transition movement, and everybody hates oil and gas. It's likened to tobacco. And so you just have this perfect storm. And you do have ESG metrics tied to CEO pay. And I do think that's really important. So you have all these, oil and gas companies who should be the ones talking about oil and gas to the market, to the investors, talking to the street about why, you should invest in their companies, but they're not doing that. And they're starting to now. You're starting to hear Darren Woods and ConocoPhillips, and you're starting to hear companies actually talk about their assets in the earnings calls. But the last couple of years, you could turn on a BP earnings call and you wouldn't know it's an oil company because all they're talking about is wind and solar. And it's honestly crazyville. So that's a reality. And so we have to understand all that complexity with this. And I'm with the previous speaker we had before lunch in terms of, betting on something that other folks aren't in. This is a really long game, and this is where I do think the CEOs of the industry have to be far more articulate. You're seeing, these massive share buybacks. And there's probably a time for share buybacks, but if you're telling the street, I'm buying back my shares because I'm not valued appropriately, you probably need to be doing a better job of telling the street why you should be valued appropriately and telling them that story and making sure you guys are part of that. So this incredible price volatility, we have seen, part of it is thin trading volumes as well. You've seen the IEA last month came out and was talking about worries about demand destruction. The IEA is the same entity that is big, has their big net zero plans that everybody follows. And the IEA is also the entity that puts out their monthly report, and they say that they're looking at 103 million barrels a day of demand for 2023, and they think that China has been demanding 17 million barrels a day this year. I've disagreed with that all year. There's no way that China's demanding 17 million barrels a day. That's a 2 million barrel a day growth from last year when they were completely shut in and having oil price at $75. Something just isn't right in the math here. China can't be consuming 17 million barrels a day and also having a slipping economy that's cratering and the property sector as bad as it is. It doesn't make sense. And so the market's off. And you do have Russia just producing like gangbusters. They've really held that 11 million barrels a day strong, and they've continued those exports. And that is really helping to fuel a lot of crude on the market. And after years of inflation and after years of higher energy prices, it is hitting the consumer across the world. And you're seeing this, you're just seeing it across the board. So I think oil prices are partly reflecting that. The thin trading volumes, Bloomberg no longer has this data for me, so it's annoying, but they used to put the traded volumes below. And you can see the big higher chunk, that's pre-COVID, and then after COVID. So less people are in the oil and gas market trading crude oil, and that exacerbates these swings. When we see a $5 swing in oil prices, that is not fundamentals. That is just traders moving it around. And I would argue that there are a lot of traders that aren't understanding the deep complexities in the market right now. And I'm usually the one that's saying, hey, oil prices should be lower, but I'm not quite sure oil prices should be lower today, given the geopolitical risk premium we really have out there. So natural gas, I mentioned this, it's really important to see where we were at the $100 an MCF that we were at, and that $15 an MCF may seem a lot lower for Dutch TTF prices, but it's not enough. It's still extremely high and elevated to where they were pre this crisis, and this has a meaningful impact on, people forget that Germany is still an industrial economy. It still produces things. It produces amazing things like cars and autos, and they are being severely impacted by their exports to China, by their flooded of imports into China, and all the stuff that they buy out of China. This has really had a profound impact on them, and you can't make things without energy. I'm going to steal something from Chris Wright, because he said this, I guess, in London a couple weeks ago, but everybody always talks about energy as a sector, and it's like a sector, and we talk about how you invest in it. Energy is the sector that allows all other sectors to work. You can't have the crypto, you can't have the AI, you can't have the data houses, you can't have anything without oil and gas, and truly without natural gas. It is not going to run on wind, it is not going to run on solar, it is going to have to run off natural gas. And that's why it's really important when you see these charts to realize that if we're not doing it and our power generation is declining and it's going to other countries, that's a problem for the world, and it's a really big problem for geopolitics and for power dynamics and for the Western world and how we compete. So copper prices and lithium prices, they're also telling us something just like oil. I do think they're telling us we're going to recession. They're usually right. If you just want to think about demand, this is just stacked up, and it's categorized by the biggest demand. You can see China in there at that 14 million barrels a day. You can see us at that 19 million barrels a day. Germany consumes a lot of oil as well, so these are things I'm pointing out. We are the largest oil and gas producer in the world. That's really important to point out because you don't hear it on TV. You certainly don't hear it from the White House, but we're at record all-time highs of 13 million barrels a day production with a fraction of the rigs that we had pre-COVID. So we are doing a lot more with less, which is telling us that we're drilling a lot of wells, we're drilling longer laterals, we have less rigs doing it, we're stepping out of the so-called tier 1 acreage, and we're still getting the oil. So this is what happens in the oil and gas industry, particularly the shale producers, is when you push them hard, they almost always deliver, and they almost always prove to the upside and prove, again, they go against the market almost every time. Okay, so the atrocities in Israel, I think this really can't be underestimated in terms of this geopolitical dynamic. The market, if you're watching, Wall Street Journal, Financial Times, CNBC, Bloomberg, the coverage of this war has been, it's going to go away. It's pretty contained. You kept hearing this, it's contained. This is why oil prices are down. I mean, it's a little, and even when the White House talks about it, they talk about Israel and they talk about Iran and they talk about Ukraine, but they don't talk about the elephant in the room, which is China. So it's all funded by China. But the problem is that this dynamic is, if you're following deep Iranian coverage and experts on Iran, the reason this was done the way it was done was to invoke the response that they got, right? These were horrific atrocities, and I've listened to a ton of Israeli podcasts. It's devastating. 1,400 people died. Yes, there's mass casualties in Gaza right now, but the way those 1,400 people were killed, and I say this because I think it's important, is these babies were killed by a boot stepping on their neck. And if you can think of the response that would invoke for a society of 9 million people who lost 6 million people during the Holocaust, it's the invoked response is what Iran wanted. So that's really important to realize when people are talking about proxies like Hamas and Hezbollah, it's Iran funding them. They only use the proxies so they can say they're proxies, but it is Iran. And so when we think about the broader contagion of this, well, Iran produces 3.5 million barrels a day, and they X 2 million barrels a day to China. And if you do the math at $80 oil, that's an easy 4.8 billion a month. So China's been funding Iran hand over fist. This administration has given Iran a massive pass, even though they're under sanctions. They shouldn't be able to export this crude to Iran, but they knew that this administration was going to be soft on them because they knew this administration wanted to cut a deal and wanted oil. This administration is the most anti-domestic oil and gas administration we've ever had in this country, and we produce more oil and gas than anyone in the entire world. But apparently it's okay to try to pacify Iran and get it from them. It's okay to lift sanctions on Venezuela, but it's not okay to talk to oil and gas companies and say, what can I do to help you and make this work? That would involve LNG permits, that would involve pipelines and things like that. But the point is that when Iran is exporting 4 million barrels or 3.5 million barrels a day, 3.2 million barrels a day, the contagion risk is real because that's Iranian production in purple right there, and you can see it's gone up. I mean, China has given them a new life in the last couple of years by allowing them to increase their output, by giving them that money, and they haven't needed to worry about the sanctions so much. And then the Strait of Hormuz, which I had on that map there, about 20 million barrels a day goes through the Strait of Hormuz. So there is a risk there if things spilt over. Will that happen? Maybe not, but the reality is it's there. And so if Iran really wanted to mess with folks, maybe they wouldn't want to mess with their, the money that they're getting in, but they could pull barrels off the market. And then, China would just go to Russia and say, give me a little bit more. So if we're laying out this geopolitical map, obviously you have Russia here, and I try to make this simple because I think there's a lot of complexity here. China, and I think we just don't talk about China enough in this space. So Russia has got this war in Ukraine. Obviously, that's not good. So you got a war in Ukraine. That's our hotspot. We've got a war in Israel now, or in the Gaza Strip. We've got Iran who's doing that war. We can just be honest about it. But Iran is also doing things in Yemen, and they're also giving money. And so, or the money goes back to Iran if you're buying this, if you're buying oil. And so you've got war and funding and money. Now China is giving money to Russia, right? And in turn, China is giving Russia also weapons. They are giving them technology. They're definitely giving them ammunitions. We all need ammunitions right now. We are short ammunition globally. Again, you cannot produce weapons, you cannot produce bullets without energy. So there was actually an article in the Financial Times talking about a TikTok facility competing with power generation on a data center because there was an ammunition facility trying to make weapons for this war in Ukraine, and it was competing with power with a TikTok facility. This stuff is real, you can't make it up. I mean, it's ridiculous. And then in turn, China's getting oil, coal, natural gas, all at a discounted price, all from Russia. And you really need to view Russia and China might not be the perfect marriage, but it's a lot like our crude that we get from Canada, which is we get several million barrels a day from Canada. It's very secure. And that's a overland pipeline. It is also really, really secure. If they want to increase that with truck, rail, or barge, which they're probably already doing, they can do that too. So important to think of in a wartime situation. They also have about 4 months worth of complete stockpiles for oil in case they did want to invade Taiwan or just, make a pain in the neck for Taiwan and we sanction them. They're okay for several months. Okay, so then China's buying a lot of oil from Iran, so they're giving them a lot of money. That makes a lot of sense. That's simple. And you've got all these, Iran sending weapons and drones to Russia. That's a little bit out of desperation. But here I want to point this out. This is China. This is the province of Xinjiang up north. That's where you have forced labor. That's where you have massive human rights abuses. This is where nothing that comes from the province of Xinjiang is ESG friendly. And lots and almost increasingly all of your electric vehicles, batteries, and solar panels and wind turbines are all made in the province of Xinjiang. The reason they're so cheap and competitive is because they're made with forced labor. And when you don't pay people, you can drop the cost of solar panels like that. And then you can flood the market and you can put everybody else out of business, which is what they've done. They're doing it in electric vehicles, and they're doing it in batteries, and they're doing it in wind. So when people are putting this on their rooftops and they're putting this on their, putting this out and they're calling it ESG friendly, that's a load of horseshit. Sorry. It just is. And they're kind of funding all of this. So you've got all this money going to, Europe is buying all this stuff, they're sending all this money to China, and China's funding all these wars. So it's very messy, and it just is a bad, and then you've got Europe saying they're really okay with this like degrowth scenario and declining. So you got a hot spot there in Taiwan where they have an election on January 13th. And we're already seeing meddling by the Chinese within the election, within the information. They're pretty worried about blockades and internet connectivity. And then you've got the Philippines, which is actually probably a hotter issue right now, and that there's all kinds of stuff going on with these little shoals and these islands and what's going on within the Philippines. You have a lot of fishing vessels that ram each other. Chinese fishing vessels are usually armed and more like a military vessel, but that's what's happening. There's a ship out there with people on it that needs to be restocked or refueled, and the Chinese aren't letting this happen. So lots going on there, but you're not hearing it in the media coverage because Biden is about to meet with Xi Jinping, and who wants to talk about the negative stuff when you've got that going on? Because it's really important to have these high-level conversations that end up going nowhere, and we usually just give them the keys to the kingdom, and we get nothing in return. This is also a old-school Chinese tactic, by the way, is to ask for a lot of stuff in return, like tell the U.S., hey, don't release the balloon report, the spy balloon report, and maybe we'll have a meeting with you. And guess what the Biden administration did? They didn't release the spy balloon report. Bloomberg actually puts the word alleged in front of the spy balloon incident, which is, it's real, it happened. And they didn't release it. And guess what? Several months later, we got a meeting. And the meeting will result in nothing, but China will eke out as many things as they can from that. That's a classic maneuvering, it's how they negotiate. Sorry, we can get into what's going on. There's a whole, the rapprochement between the Saudis and Israel, that was gonna happen right before the war. So the day before the war breaks out, there was a rumor that the Saudis were gonna throw 1 million barrels a day on the market. I think that rumor is pretty decently substantiated. I think they were thinking of doing it if the U.S. was willing to give them nuclear power, and if basically, and then in return the U.S. was gonna say, hey, make peace with Israel. That's all built upon the Abraham Accords from the previous administration on Arab countries just dealing and talking with Israel and having better relations, and that all fell apart. Now, Iran obviously didn't plan that timing perfectly, but they probably ramped up or could have ramped up the attacks or the viciousness of it in response, just to invoke that response, because immediately Saudis said, hey, we're not going through with that deal. So that's the ongoing war with Ukraine. The Institute for Study of War, they have great maps, by the way, if you haven't seen them. That's when it started. That's what it looks like today. We're nearly 2 years in. There is no end in sight. It's really expensive. That's that Finnish pipeline I was talking about, the sabotage that's driving prices higher. European natural gas production and consumption was last year, during the war in Ukraine, 55 BCF a day. They only produced 20 BCF a day. Production increased a smidge last year, but that gap they have to fill with imports. And so their exposure to Russia was 18 BCF a day, 16 BCF a day via pipeline, and 2 BCF a day via LNG, which they're still getting some of that from Russia, by the way. So they opened the door to this. So these are the countries that are leading the world on the energy transition, leading the world on ESG, pushing on the UN, pushing all the investment community to change the way they invest in oil and gas. They're the ones that had the exposure to Russia. They're the ones that allowed this war to happen, and we're listening to them. And we really shouldn't be, because this is the road you don't want to go down, which is don't produce your own stuff. And they have the oil and gas. They absolutely have the natural gas, but they won't produce it. And this is what happens. The financial assistance to Ukraine, the only reason it's important to mention is war fatigue is real. It's definitely setting in. And so the longer these wars go on and the no end in sight and the cost to them, it's an uncomfortable thing to talk about, but it's real. And the fact that we have our interest payments on our deficit are $1 trillion, which is more than our military spending. This is a real thing. And the previous speakers alluded to this and talked about the deficit and interest rates and all that, which I normally spend time talking about, but it's all very, very intrinsic and very involved. So we produce nearly double that of natural gas, or double that of Russia for natural gas. I mean, Russia's about 60 BCF a day right now for natural gas production. Everybody thinks they're the largest natural gas producer in the world. They are not. Our gross withdrawals today are 124 billion cubic feet per day of natural gas. To put that in context, the world consumes and produces, the global market is 400 billion cubic feet per day. If we wanted to drop CO2 emissions globally, we could do it in a heartbeat by exporting natural gas to Vietnam, to China, which they won't take, and to India and to all these countries and helping them with their infrastructure. We could solve it. So it really starts begging the question of, is this about CO2 emissions? And I would say it's probably not, because I'll show you that data in just a little bit. So the tensions with China, I mentioned this, those are really serious. Again, Institute for Study of War, just awesome. They started this awesome Chinese-Taiwanese coverage. China is also extremely involved in the disinformation campaign that's going on with Iran and the war. If you heard about the hospital that was bombed, but then found out it wasn't a hospital, it was a parking lot, and 500 people apparently died in the hospital, and then we found out it wasn't Israel who did that, it wasn't the IDF, it was actually the other side, and then you find out that, hey, there are all these tunnels underneath all these civilian centers, and so if you've got to attack the tunnels, you're going to hit the civilians. Why do you think they developed the tunnels right under the civilians? It was protection. But that disinformation campaign and the involvement that China has in their propaganda apparatus, it's seriously at work right now, especially through the developing world, especially through the Middle East. So you have to be careful on the information that you consume. And I can tell you, I do research for a living, and it's primary sources, and it's a lot of work now to get the right information. So China militarily as well, I mean, they are ramping up. They just said that they're going to potentially do a military base in Oman. That would be really serious. It would certainly complement their asset in Sri Lanka. It would certainly complement their asset in Djibouti. And it does look like they don't just want to sit there and do nothing forever if they're doing this. I mean, you just don't do this. There's peace through strength, but China has never been, that's just not their MO. We are sort of the peace through strength, and this is a new element, and the fact that this is ramping up and the role that China is taking in the Middle East, it doesn't typically go well. The Middle East is very volatile, but they're doing it none the same. The Barbie movie. You probably didn't think we'd be talking about that, did you? The Barbie movie is important. So I'm supposed to get laughs. This usually works in other groups, okay? So this map, I don't know if you saw this. I have to do this because it's just fun. There's this map here with Asia and these dashes over here. And I say this, it's relevant because there's a lot of people pacifying China on every level, including Hollywood. And so they've been known. And so there was this talk about this Barbie map and this dashed line out here and how this was a big deal. And there were folks saying, no, I listened to a ton of China stuff, and people were saying, no, this is just a squiggly line. It means nothing. It's just a Barbie map. But then you watch the movie, which is horrible, by the way, but you watch this, and it's like up there for several minutes. And then I listened to the CEO of Mattel on Bloomberg or CNBC, and he says directly, they ask him about this map, and because Vietnam banned the movie because of this map. And he says, no, basically, we want the Chinese market. So we did do this map for China. So that's really deplorable, because this map is about their 9-dash line, which they just extended to their 10-dash line. So if you count those lines, it's like a squiggles. But the 9-dash line is basically a very old map that they say they have. It's a claim. It's completely and utterly ridiculous. But it claims all the stuff in the water, all these territorial waters. They added a new dash, a 10-dash, recently on this far right map, and it just kind of perfectly encapsulates Taiwan, just throws it in there with them. That's pretty serious, because it just is saying, hey, this is ours. And that's kind of what China does, is saying this is ours. So that's why the Barbie movie is relevant. Okay, so the White House, super fun, because I already told you they're anti-domestic oil and gas. This is like the first thing on the website if you click the climate button on the White House. I just point this out because those are solar panels that probably came from China. I mean, and by probably I mean they did. If they came from Malaysia or Vietnam, they came from China. You can't make any part of the solar panel, which is almost 100% done in the province of Xinjiang with coal-fired power generation with forced labor. So that's not a very friendly picture, in my opinion. And that map they're looking at, if you zoom in, it's just a white piece of paper. Seriously, there's just nothing there, which kind of encapsulates to me what this administration is doing on energy, which is a whole lot of nothingness and standing around and talking about it. The Strategic Petroleum Reserve. We have to go to Venezuela and lift sanctions on Venezuela because we have drained our piggy bank for the Strategic Petroleum Reserve because Biden and all the Democrats wanted to get reelected last year, and so they did drain the Strategic Petroleum Reserve. And now we have 2 hot wars and potentially a third and all kinds of tensions, and we have half of what we should in our piggy bank. And I'm way over time, so you guys are just going to have to let me know if I can run over, or we'll dip into Q&A. Okay, 13 million barrels a day production. I told you this. That climb back, it's really remarkable. Natural gas, important in this context. Okay, U.S. net power generation. That's that total line in red. People know that. Important to point out, and the reason people are getting a little longer on nat gas is because we've shoved so much of that wind and solar in the bottom, that red and blue, into the grid, particularly in this state, is that, yes, the only reason you've been able to have it in Texas is because you have so much natural gas-fired power generation. But when you don't have that wind and solar, and typically when it's really cold, it's not windy. When it's really hot, it's not windy. Again, that doesn't seem to make sense if you think we're going to have climate change, which means extreme weather, which means the things you're building for climate change don't work. So that doesn't make any sense. But the point is those being added, people are making calls on nat gas spike bets based upon having too much of this into the grid. And you can see that nat gas went up, coal went down. Okay, IEA net zero. If you are an oil company, if you are an investment entity, or if you are anyone on ESG and you are touting IEA net zero, it's really important to know what you're touting, because it's that green line, and that is a 25 million barrel a day demand drop from right now to 2030. So in a handful of years, we're going to cut 25 million barrels a day of demand out of the market. It's not going to happen. Like, it physically won't happen. At the very least, we'll continue to probably consume 102 million barrels a day demand and probably not decline. But that's the scenario, and that's what they're banking on. And they're saying, hey, we'll just electrify the grid, and we'll just build out electricity, and we'll add a bunch of wind and solar, all of which, by the way, they say comes from China. So it's a really messy and convenient narrative that works for almost nobody but China. And that's their scenario for natural gas. This is really fascinating and very political, and that the International Energy Agency in 1973 was developed because we had energy crises, and they were developed to ensure that the world was stockpiling oil. Now they're an advocacy group, and the fact that they changed their outlook on natural gas, which is the reason natural gas works is because it's a high BTU content gas. I mean, it's high in BTUs, it's high in energy, it's energy dense, and it produces heat and it produces power. And so they changed their outlook dramatically from 2019 to now to say we're going to be consuming a lot less natural gas. That makes sense? Not at all, given that here's our oil consumption. This is what the history of oil consumption is. That's 2022. It recovered from 2021. That's coal on the left, which went way up last year because of the war in Ukraine. So wars not only produce CO2, they risk energy security, and then people have to go to coal, which is extremely energy secure, because you don't have to compress it, you don't have to put it in a pipeline, you do not have to put it on a fancy LNG tanker, you can put it in a truck, you can just stack it up next to a power plant, and you've got it. And guess who has the most coal in the entire world? It's actually not China, it's us. We have a crap ton of coal, and we have energy security if we want it. I'm not saying we should burn it all, but yeah, have it as a stockpile in case you need it, and in case you need to make sure that people can heat their homes and do it in a efficient, reliable manner. But we don't really need it because we have so much natural gas. That's natural gas on the right. So their forecasts of it going down are just make no sense at all. This is outside of reality. OPEC's long-term outlook, just to put in comparison, this is their long-term outlook, and I just put that triangle on the bottom there. That's IEA's net zero, and that's OPEC, and that's where they've revised. So they're completely offsides in how they view the world. This is where I say the disinformation and information is super important. I get a lot of my news and media from Bloomberg. I'm sure you guys do as well. But Bloomberg is a huge backer of, and when I see the word alleged in front of spy balloon, it gives me a lot of pause. Bloomberg does decent coverage of stuff. You kind of have to dig into it a little bit to get that coverage. But Bloomberg has this big Beyond Coal campaign, and he's put billions and billions of dollars to it. But it's also beyond natural gas. It's actually beyond all carbon. So he wants all natural gas-fired power generation out of America. So I just showed you those charts. I mean, what are we going to do? We're going to all eat mung beans and live in a cave and not have power? I mean, that's basically what we're doing, is saying you're just going to take out that power. And it's really sad because, I mean, that's global power generation by fuel. That black is coal, the red is natural gas. That's global power. So over time, you just need more power, not less. And actually, if you believe in the energy transition and you want to electrify, you have to be building out global power generation like mad. You need to be increasing, not decreasing. And Europe is decreasing. That's global CO2 emissions on the left. That is China in red. And you can see us is next, then it's Europe, and then it's India. So Europe is trying, but they're where they're at. And if you see it in a little, so it's electricity. This is what the IEA is saying. You need to grow electricity. That's what Europe is doing. They are declining, if not flatlining, in electricity output, which is not going to work. They're calling this degrowth, but it's not going to work because if you buy an electric vehicle, you have to plug it into the grid. And so if you electrify everything, you're going to have draws on power generation. And you're already seeing this with the inability to build stuff out, the costs going up and everything. It's not an inevitability. We may have an inevitability on people not working and we need to get them back to work and higher labor costs, but it's not an inevitability that we have higher energy costs because we have a lot of energy. That's Chinese CO2 emissions in comparison to the US. That's what it looks like. Our CO2 emissions have dropped, and that is because we have shoved a lot of natural gas into the grid and we pulled out coal. That's simply put, that's exactly what's happened. And that's US power generation versus China. China added more than 1,000 terawatt hours of coal-fired power generation in the last couple of years. They added more than 1,000 in 2021 alone. We do not even have 1,000 terawatt hours of coal-fired power generation. The reason they do this is because they have a lot of coal. They don't have a lot of natural gas, and this is energy security. So when you hear China is adding wind and solar into their grid, that's energy security too. It's actually not very efficient. They tie it in with coal. They don't use, whether or not they use it is a question of whether it's tied in, and it's helping them because they get to export it, and it's they have a huge green tech market now that they're exporting to the rest of the world. But it's all about coal, and if you think China is ever going to change they're going to reduce their energy security because John Kerry or Joe Biden has asked them to, they're not. There's not a fair chance in hell that China is going to reduce their internal energy security because we, the West, want them to decarbonize, and that's how they keep things low in cost. So the EU trade with China, that's just solar panels. That is nearly 140% increase in the war in Ukraine alone. So there was one country that won, that is China. People have been buying these solar panels. Also something to note, these solar panels are, they're said to last 20 years. They probably last 12 if they're good. Some Chinese solar panels last a whole whopping 1 to 2 years, which means your capital refreshment costs for countries in Europe who have pulled this in like crazy are high. And we could have real serious externalities within the existing grids of just solar panels that we put in place right now that nobody's talking about. Obviously, China dominates. onshore wind turbine market, they dominate the electric vehicle market because they dominate the battery market, and it's really because they dominate the dominate the processing of these critical minerals, from copper to graphite to everything, and that's because processing is extremely dirty, it's environmentally intensive, it requires a lot of energy, which they use the coal-fired power generation for, and you have to extract things like uranium and thorium off of this stuff. And they're the only country that does it because the rest of us don't want to do it because it's dirty. So even if we try to pull these supply chains in, like Robert Kaplan was saying, we're not going to pull in half of them because the world is anti-mining, because you have to mine with diesel, with caterpillars, and dig this stuff out of the ground. And that's what we have to do to actually have this energy transition. But you also need just copper every day for everyday use. You need graphite for the military. You have this stuff in everyday use. So it's really important when they control this. And then that's their EV exports that they're just exporting like crazy into the market. That's the province of Xinjiang. Trust me, I take this work seriously in terms of the human rights abuses. They are massive. They are devastating. So if you are into the energy transition and into ESG, this is something you need to look into, because it is not. I'm not paying lip service. There are millions of people that are working forced labor in China, which is why we have all our stuff for cheap. That chart is from the IEA. That's the cost of power generation. China subsidizes the coal-fired power generation, even with it being cheap. They subsidize the water. They subsidize, they incentivize businesses to go up to the province of Xinjiang, and then they give them forced labor. And sometimes they send that forced labor from Xinjiang and they put them on buses and they send them to other places in China. So if you think you're buying something from China without forced labor, you might not be. And that study, it's called In Broad Daylight from Sheffield University. It is just phenomenal. It's definitely worth a read if you do anything in supply chains. I talked about Germany's cost being up. Their electricity is very high. That's Germans or European oil demand. It matters a lot because we could be getting, if we start seeing some softening in Europe, which we're already seeing, oil demand could continue to slip, and that's going to impact price. That's probably what's already happening a little bit right now. That's German oil demand on the right. Chinese oil demand, we talked about this already. I'm showing you that. That's what it was. It came down a little bit during COVID. I don't think it went to 17 million barrels a day when they lifted COVID zero, and their property market is in decline. The property sector, you can't underscore enough. It is really, really serious because that's their largest property developer. All these guys have tanked. You really can't invest in Chinese companies the way we invest in the stock market. People just invest in them kind of as a trade, but it's not something like, hey, they're cheap, go in and buy them now. Nobody's really doing that because they're not tangible assets, and a lot of them can be fake. The government has a huge hand in most of them with their golden shares now. But if you look at that property index, this is a fantastic article from the Financial Times, and all the actual prices of these properties have declined massively. This is not just in the tier 3 cities, tier 4 cities, this is in tier 1 and tier 2 cities like Shenzhen, Beijing. You're seeing prices actually decline, and so the material impact of this is huge, and it's not really being appreciated by the overall stock market, I think, in terms of what it means for commodities. I told you Russian production has been extremely resilient. Their exports have been up. We basically haven't had effect on sanctions because their gap is pretty narrowed. And I know I'm over time. Just give me a couple more minutes. Saudi Russian oil production. The Saudis have committed to another 1 million barrel a day, or not another, but a continued 1 million barrel a day drop. So the fact that we have $75 and change oil prices, and the Saudis said just a couple days ago that we are committed to our 9 million barrels a day, we're definitely, something's off here, both with traders and demand. And then, Robert Kaplan mentioned this, and folks mentioned the inflation. That's your average price of chicken, just on the left. That's electricity on the right. These are very high. They're not sustainable. You guys can nerd out with this slide later, but it's awesome. If you stack unemployment, Fed interest rates, inflation, and oil prices, there's a clear trend, right? You drive up, but your unemployment comes way later, right? Unemployment always comes a couple of years after your big peak of everything. So I do think we're going to have a coming recession. I do think unemployment has to go up. And it's not right now, but it's coming because there has to be a breaking point. If you look at housing and WTI, if you look at where we were at housing in 2008 and where we're at going forward, we're probably hitting a breaking point there. Oil demand in the US has not recovered. We have not recovered pre-COVID in gasoline demand because there's still so much of a work from home lag where people aren't commuting. So we're driving a lot, but we're not commuting the same way. That's having a huge impact on commercial real estate. It's having a huge impact on local businesses that are that would have got business from restaurants to stores. So that's a looming big issue. I know folks are going to talk about that next. We are seeing a little softness. I'm going to close with, the UAW auto strikes, I think, were one of the most serious things that if you really looked at them, you would have seen that it was about the energy transition, because it was really about electric vehicles and the fact that you need less people to make electric vehicles than you do internal combustion or ICE engine vehicles. And so the UAW auto strikes were basically trying to guarantee that people had jobs, literally guaranteed pay. They wanted 5 days of pay for 4 days of work, and which is pretty astronomical given the average hourly work week is only 33 hours right now. And I think you guys and myself, I do that in a couple days, if not 2 and change mostly. But they also wanted guaranteed pay forever, even when their jobs were gone. They wanted to basically put them in a community service. So these were things that they're not real. And these companies all went bankrupt, and we had to bail them out in 2008. So, and the crux of this is the energy transition, because guess what? All these companies, if you listen to the earnings call, EV demand is very soft. They're having to roll back their EV production, yet the government is telling them they have to make them, and things are completely offsides. And the government is incentivizing rich people to buy EVs with tax breaks, and we have all this inflationary aspect. So it's a kind of a crux and a microcosm of what we're dealing with. And lastly, I just want to point out on U.S. shale, it really is crushing it. I mean, our production is way up. I talked about the share buybacks, and that companies need to talk about that more openly. Exxon has been actually pushing back. They are starting to talk about ESG pressure equating to lack of investment in the space. So I think the answer is if you help resolve the ESG pressure, you can invest more openly in the space. And the acquisition environment, we talked about that. And lastly, I'll just show you the average lateral length in the US is over 10,000 feet. You're seeing increasing lateral lengths drilled at 3 miles, at 4 miles, and some even pushing that. So we are doing a lot more with a lot less rigs, and actually less people as well. The implications of this are huge, but you can tell I'm pretty bullish on US shale. We can get into that, the publics, privates, and everything. So thank you so much for your time, and I apologize for going over. For maybe 1 or 2 questions?
First off, as a Jew, I appreciate your comments on the atrocities that occurred about a month ago. It's good to hear that what could be going on. But my question in terms of the SPR is that does it get filled at some point? What breaks first? The administration start turning back to fracking and shale, or do we just buy hand over fist from Saudi Arabia at prices that are astronomical?
Those are great questions, and I appreciate your comments. I'd spend more time talking about Israel if I could. So the SPR is a conundrum. The administration said they were going to fill it at a certain price point, and they didn't. So I am not going to bet. Just honestly, if I'm gauging this out, I'm not going to bet that this administration is going to stay to their word on anything related to domestic oil and gas. I don't think they're going to fill it. So the next administration, if it's a different one, I would think that they're going to have to fill it, and that would be very positive for U.S. producers. But we're going to be in a pickle if we have to, if we're buying hand over fist at those prices. I think the pressure on the administration is going to be huge. So they should have started filling it when prices had dropped before. They have some incentive to do it now, but then they're kind of putting a floor on it. So it has to be filled. It's a big problem. If we have softness in the global economy, softness in the U.S., softness, and you actually have softness in oil prices, that's a good time to say, hey, shale guys, we'll put you back to work, and we need to fill it with SPR. But I don't think it's going to be done under this administration.
All right, one last question.
Really appreciate your presentation, hitting 3 hours into 45 minutes.
Glad I could do that for you.
Yes. Just could you expand a little bit more about how the transition to green energy is not really ESG friendly?
Yeah, I mean, simplistically, and I have to cover in a short time period, but it's your human rights abuses are number one. So personally, I think that forced labor and child labor in the Congo for cobalt is worse than CO2 emissions. I do feel that. I do think it's all for naught when you're looking at that chart of CO2 emissions, and then you're putting things into the grid. So it's not ESG friendly from a humanitarian standpoint. So the stuff you're getting from China, it's almost exclusively from China, and it's made from forced labor with coal. That's how China competes. That's how they keep the cost low. So that's one. And two is that it's not CO2 friendly. The life cycle emissions are atrocious on this stuff. And it's also, it's not allowing other economies to even compete or to thrive. We can't compete in this space, and we've relegated all of our production to China. So we've actually enabled China to continue to increase CO2 output and to actually build not just their base for electric vehicles and solar panels, but I would just wager a guess that they can produce other things than solar panels and electric vehicles. I'm guessing they can produce machinery and weapons and ammunition with that power generation as well. So from simplistically, it's not ESG friendly from a humanitarian standpoint or a CO2 standpoint at all. And the world has to wake up to that. And the people who are investing in this stuff need to start realizing that if Tesla is making a car in Urumqi, which they're bragging about, and it's cheaper, and they're using forced labor, it's not environmentally friendly either. And nor is the end battery just the actual components of that battery. All of it's pretty dirty. And I think the dirtiness from an environmental standpoint extends well beyond CO2.
Wow, that was great. Thank you so much, Trisha.
Thank you. Sorry for not getting into the shale.